Hello again, my fellow Canadian investors. I am Justin from Tater. In this video, we are going to discuss Wealthsimple's classic line of managed investing portfolios. So these are Robo-Advisor style portfolios. Wealthsimple has three main categories: SRI, Halal, and Classic. We're going to discuss the classic, otherwise known as standard portfolios. So these kind of portfolios are based on modern portfolio theory principles. So essentially, Wealthsimple attempts to optimize the risk-return trade-off for its portfolios to help investors achieve their financial objectives while effectively managing risk. So when you sign up, they ask you a bunch of questions related to your risk tolerance, also your time horizon and general investing goals. From there, they provide or recommend a portfolio with a specific asset allocation, so the appropriate mix of stocks and bonds based on your answer. From there, you can increase or decrease the allocation towards stocks if you prefer. So in this video, we will talk about all of the portfolios in the Wealthsimple Classic Managed Investing series. We'll look at the underlying holdings, so the specific ETFs that are held in each of these portfolios. We will talk about the costs, general structure, how the portfolios are built, and make sure you stick around to the end because, as you'll notice as we go through the video, we make some references to building the portfolio on your own. And at the end of the video, we will discuss how to build this portfolio as well as many other Robo-Advisor portfolios. Some of them are more practical to build on your own than Wealthsimple's line. So stick around to the end. We'll talk about how you can easily build them on your own, and it is worth it. If you save on all of those fees, they can amount to a huge amount of money over the long term, often well into the six figures. So stick around to the end, and let's get started. As you can see, their different offerings are numbered. So let's open up Wealthsimple 1, 4, 7, and 10. Number 1 being the most conservative and 10 being the most aggressive. Now, it's important to watch this next section for investors of all risk tolerances because even though we are going to be looking at the risk level 1 with the highest percentage of fixed income, the more aggressive portfolios with higher percentages of equities have the identical ETFs as this one. Right off the bat, you will notice quite a few ETFs. There are 9 in this portfolio. So a considerable amount of complexity, and adding to that for investors looking at building this portfolio on their own, 2 of the ETFs are in US dollars. We'll comment a little bit more on the first one for now, the Global Equity ETF. So this one contains equities from Canada, the US, the international developed and emerging market, but then there are 4 separate ETFs that cover these areas individually. One important note about the global ETF is that unlike many ETFs in a Robo-Advisor portfolio, this one is not market cap weighted. As you can see here in the fact sheet, this is a minimum volatility ETF. Minimum volatility ETFs generally offer lower expected returns over the long run compared to their market cap weighted counterparts. This is because minimum volatility ETFs are designed to reduce portfolio volatility, and they do this by selecting stocks that have had historically lower volatility or beta values. By selecting stocks with less price fluctuation, these ETFs aim to provide investors with a smoother market experience. So you wouldn't see as extreme ups or downs during turbulent market periods. Market cap weighted ETFs, on the other hand, track indexes that give more weight to larger companies, those with greater market capitalization. This means that you would have higher exposure to bigger companies in your portfolio. These larger companies can often include growth stocks that have the potential to generate higher returns, especially during bullish market phases. The emerging market holding in this portfolio, EEMV, is another minimum volatility ETF. And I'll talk more equities momentarily, but for now, just wanted to focus on the fixed income portion of this portfolio. As you can see here, there are 3 separate ETFs, which doesn't seem too excessive, but if we have a closer look, ZFL is a long-term federal bond index ETF. Like the other 2 fixed income ETFs in the portfolio, it strictly contains bonds from Canada. HBB is your standard universe or aggregate bond index ETF, which would cover a large swath of Canadian investment grade bonds, and most would be government. The Vanguard offering, VSC, is a short-term bond index, and an important note, it contains all corporate bonds, which generally have a higher rate of return, but you have to factor that in, that they also have greater volatility and so more risk. Generally, when you get a short-term bond ETF, you expect to have low volatility, but the fact that it is a corporate bond ETF kind of nullifies some of the reassurance you would feel in owning this. Rounding out this portfolio, we have a gold ETF that has an allocation of 2.7%. As you can see, the overall MER is 0.15%. Not bad for a portfolio. However, if you are dealing with US dollar ETFs, then you probably want a lower MER than this. Furthermore, if you are working with US dollar ETFs, then you probably want, at the very least, for your US equity ETF to be in US dollars. Some US dollar equity ETFs have very low MERs. ITOT, for instance, has an MER of only 0.03%. It tracks a US equity market index that is measured by market cap. And HXS, for all intents and purposes, does the same thing. It attempts to replicate the S&P 500, which doesn't provide the same small and mid-cap equity exposure as ITOT, but that shouldn't have an effect on the MER. And as you can see, that expense ratio for this ETF is 0.11%, which is not bad at all for a Canadian dollar US equity ETF. But if you are having to deal with US dollar ETFs in this portfolio, then you probably want, again, your US equity ETF to be one of those ETFs that is in US dollars. One final issue we wanted to mention when looking at this portfolio, the global equity ETF that they have, that first one does have a Canadian holding, so you are converting over to US dollars to invest in Canadian equities, which has some obvious inefficiencies. Let's now hop over to the risk level 4 portfolio. This one would be widely considered a balanced portfolio in that it has 50% equities, fixed income is just under 50%, as they have 3.79% allocation towards gold in this portfolio. All of the same ETFs that you saw in the previous portfolio, the classic level 1. The MER in this one has jumped up to 0.18%. So again, if you're having to deal with US dollar ETFs, then you probably want an overall MER that is significantly lower than this. You've got just about 26% of ZFL, the BMO Long Federal Bond Index ETF, and long-term bonds typically have significantly more volatility than short-term bonds. So you would probably want the majority of your fixed income holding to be HBB, the Horizons Canadian Select Universe Bond Index, as this one contains not only long-term bonds, but also medium and short-term bonds. Unlike ZFL, this ETF does contain some corporate bonds, which would lead to it being a little bit more volatile than an ETF that was strictly government bonds. However, with the medium and short-term bonds, it would almost certainly exhibit less volatility than ZFL. It might also be a good idea to have additional short-term bonds, like this portfolio does. However, as we stated before, that bond ETF VSC is strictly corporate bonds, which means it would not be as reliable as a short-term bond ETF that was all or mostly government. So to sum up the thoughts on the fixed income portion of this portfolio, it would be nice if there was a larger allocation towards HBB and a smaller allocation towards ZFL, and probably smaller allocation as well towards VSC. Or there could even be a different ETF altogether, a short-term bond ETF that was all or mostly government bonds. Okay, let's hop over to the risk level 7 portfolio and have a look. As you can see, 75% equities, 22.6% fixed income, with the rest allocated towards gold. All of the same ETFs that you've seen in the previous portfolios, and a lot of the same notes from us as well. We'll just focus again on the fixed income. As these portfolios get more aggressive, the majority of your fixed income should probably be in very safe holdings like your aggregate bond ETF, the HBB, or short-term government bond index ETF. As you can see in this portfolio, the vast majority of the fixed income holdings are in ZFL, the BMO Long Federal Bond Index ETF, which will exhibit significantly more volatility than a bond ETF that had equal weighting of short, medium, and long-term bonds. Again, the MER is 0.18%, probably too high if we are needing to deal with US dollar ETFs. Hopping over to the risk level 10 portfolio, 90% equities, 7.5% in fixed income, and all of that 7.5% is invested in ZFL, the long-term federal bond index ETF. So 7.5% in fixed income in the upper table is a little bit misleading because we are invested in a more volatile ETF than you would typically see in the safe portion of a portfolio. MER is again 0.18%, and our comment remains the same. Again, that is probably too high to justify having to work in US dollars. Let's now sum up the most important takeaways from our review of the Wealthsimple portfolios. There are 2 US dollar ETFs, but then the US equity index ETF is in Canadian dollars. The portfolio probably has more ETFs than are really required. There is some overlap with some of the ETFs. For example, there is a global and an international equity index ETF. Another example from the fixed income side of the portfolio. There is an aggregate bond index ETF that holds short, medium, and long-term bonds, but then there are separate short and long-term bond index ETFs. So all of this overlap just adds unnecessary complexity to the portfolio, and the major drawback is probably that this complexity just makes it hard to ascertain what percentage we have allocated to Canadian equities versus US and then international, developed, and emerging markets. Moving on, another note is that the fixed income portion of the portfolio is much more heavily weighted towards long-term bonds than other index ETF portfolios. The short-term bond ETF is comprised of all corporate bonds, and short-term bond index ETFs are typically located in portfolios because they exhibit low volatility. However, corporate bonds exhibit higher volatility than government bonds, so we would probably prefer to see an ETF in here that was comprised of mostly or all government bonds. Finally, Wealthsimple's safest portfolio, their level 1, has 67.3% fixed income, whereas most safe portfolios would have at least 80%. So if you are looking for a very safe portfolio, then their level 1 portfolio probably doesn't have enough fixed income for you. Before we wrap up here, as we promised at the beginning of the video, we will show you how you can build these portfolios on your own. And as we've discussed, the Wealthsimple portfolios probably aren't the most ideal ones to build on your own. So we will go back to the menu here and you can see all of the portfolios we have loaded into this spreadsheet. The share prices are live. So all you have to do, if we go over to the RBC growth portfolio as an example, this is a more practical portfolio that you can build on your own very easily, as it's all in Canadian dollars. All of the share prices are live in Excel, Microsoft 365. So all you have to do is load up the total initial amount you have to invest. As you can see here, we put in $75,000. Then it'll show you the number of shares to buy. You go down and fill in those shares as you actually buy them through your brokerage. So this spreadsheet makes it very easy to build this portfolio and equally easy to manage it moving forward. As you can see, the Take Action column will show you when you need to buy or sell any shares to bring your portfolio back into balance. And then when you have some additional cash to invest, simply enter that into the Cash to Invest cell. From there, the column to the right of the Take Action column will show you how many shares of each ETF you need to purchase. So as you can see, very easy to build and manage these portfolios on your own. Moving forward, you can save a ton on fees. Like we said at the beginning of the video, this can increase your portfolio by an additional 6 or even 7 figures over the long term. So life-changing amount of money. It's worth it to build these portfolios on your own. Just go to mytater.ca, sign up for our course. Right now, we are offering 50% off for our YouTube subscribers. So subscribe, like, share, and we will see you next time.